Hey everyone, in this video we are going to be doing again more FIFO, LIFO, and weighted average examples. But this one I want you to notice something a little bit different. So the last ones that we've been doing with the FIFO, LIFO, weighted average, and SI2 is that everything in that company's life cycle has been, I'm going to purchase some inventory, I'm going to purchase some more inventory, I'm going to purchase some more inventory, and then at the very end of the year I'm going to sell everything that I have at that time, or at least as much as I can. So it's a lot of purchase, 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 and then one final big sale. But we know most companies don't work like that. We know that most companies are out there going to go, purchase some, sell some, purchase some more, sell some more, purchase some more, maybe purchase a little bit more, then sell some more. But they have this intermittent purchases and sales. And so I want to show you how to do LIFO, FIFO, and weighted average using intermittent purchases and sales, so you have, a overall look on how to do these things with different types of businesses. So if you notice right here, Echo Company has the following beginning inventory, purchases, and sales. And you notice it says we have beginning inventory, then we have purchase, and then we sell, then we purchase some more, then purchase some more, then sell some more. And this can go on, infinite amount. But I just want to kind of give you a quick preview of this, or at least a quick example of this. And then it says, I want you to find, using FIFO, the cost of goods sold, the gross profit, and the ending inventory for this example. So let's get into it. Let's start with the first one, the beginning inventory. We don't do anything with that because remember, we don't journalize beginning inventories. Those were journalized in the previous year and they were carried over to the current year. So now we're going to start with 115 where we purchased some inventory. And so our inventory goes up, our cash goes down. So we're going to start with 115 as our date. Inventory is going to be our debit. And if we multiply 150 times 12, we'll get 1800. And then our credit will be cash because, again, we paid for it in cash. We're assuming we paid for it in cash. And so cash for 1800. So that takes care of the 115 purchase. Now we get to the 4-1 sale. And we sold 175 at $25. So now we're making our first sale. And this is, again, how I would go about doing it. So I'm going to start with my date, 4-1. And I'm going to go ahead and put all the account names down. I'm not going to put the numbers with them yet. I'm just going to go ahead and put the account names down. So cash, I know, and then sales revenue, that's the first part of the equation. And then we have COGS, or cost of goods sold, and inventory. So I know that's my debit, my credit, my debit, my credit. I'm going to first look at the sales, the cash and the sales revenue side. What did I sell it for, and what did I earn off of it? So in order to do that, to start with that, I'm going to calculate how much I sold, or what I sold it for. So my sales revenue would be the 175 that I sold times the $25 I sold it for, and that would give me 4,375, and that would be my sales revenue and my cash. So if I go over to my journal entries, I'll put those into the debit and the credit for those appropriately. Now, also one other thing, especially when I'm doing intermittent purchases and sales, I tend to do this just because it is going to keep me organized and I'm less likely to make a mistake. And you'll understand this as we progress through this, but I'm just going to put a little slash mark through the 175. I'm done right now with the 175. I don't need to worry about that right now in terms of recognizing more. And now, granted, I will still have to expense those, but I don't want to use that as a purchase. So now let's get into the cost of goods sold and inventory. I need to expense those 175 that I sold. So 175 is the number that I need to hit. And because we're using FIFO, first in, first out, it's more or less a top-down approach. I'm going to start at the top and work my way down until I hit 175. So the first place I'm going to pull from is the 50 at the very beginning, in our beginning inventory, 50 at $10. And if I multiply that out, that's going to give me $500. Now I'm also going to put a slash mark through that 50 in a different way, in a different direction, to let myself know I have no more of those 50. Okay. I still haven't hit 175 yet, so now I got to take out somewhere else. The only place I can take out is from the 115 purchase. And how many of those 150 do I take out? I need to take out 125. That will give me 175 total. So 125 at $12, that's going to give me a total of $2,000. I'm also going to put a little slash mark through the 150 purchase because I don't have 150 anymore. I actually have 25 left. So I'm going to put myself a little note there that says, hey, don't forget, you still have 25 of these. Now going back down, I need to add up the 500 and the 2,000. That's going to give me 2,500. And that right there is my COGS, my cost of goods sold. So I'm going to put that into my journal entry. So 2,500, 2,500, and that takes care of my sale. All right, now we can go to the 5-1 purchase, which is the 200 at 15. So I can go ahead and do a journal entry for that. I'll say 5-1 inventory, multiply that together. That's going to give me 3,000. And then again, credit cash for the same 3,000. All right, that takes care of that purchase. Let's go to the 6-2 purchase. Same thing. Inventory goes up, cash goes down. I'm going to multiply 225 times 16. That's going to give me 3,600. Same thing with cash, 3,600. Now we get to the sale on 7-11. We sold 430. So I'm going to go ahead and put my accounts down. So cash, sales revenue, cost of goods sold, and inventory. And then I'm going to start doing the calculations for it. So 7-1, I need to find out first what I made in sales revenue and what I received in cash. So my sales revenue is going to be the 430 that I sold times the $25 I sold them for. And that's going to give me a total of $10,750. So I'm going to go ahead and put that in my journal entry, $10,750, $10,750. And then again, I'm going to do the same thing I did with the last sale. I'm going to put a little slash mark through the 430 because again, I don't want to make a mistake and use that as a purchase. It's not. It was a sale. All right. Now we're going to go into the cost of goods sold. I need to figure out how much I need to expense. So 430 is the number. That's my magic number that I got to hit. Where am I going to draw from first? Well, again, we're still doing the top-down approach, so we don't have any more in the beginning inventory. We still have 25 in the January 15th purchase. So I'm going to take all 25 of those. That would be the first place I pull from because that's all I have. So 25 at $12. That's going to give me a total of $300, and I'm going to put a little slash mark through the 25 because I don't have those anymore. Now, this is the reason why I put a slash mark in a different direction on the sales. I don't want you to, if you didn't have that slash mark over the 175, I don't want you to go through and make a mistake and say, hey, I've got 175 at 25 that I'm going to expense. Remember, that's a sale. That's not a purchase. So I'm going to go to the next purchase or the next inventory. So the next one will be the 200 at $15. And remember, I got to hit 430. So I'm going to take all 200 of those. So 200 at $15. That's going to give me 3,000. Put a little slash mark the other way on the 200 because I don't have any more of those left. And then the last place I'm going to pull from is the 6-2. And I'm going to pull, in order to get to the 430, I need to still pull 205 out. So 205 at $16. That's going to give me 3,280. Put a little slash mark through the 225 because I don't have 225 anymore. I only have 20 left now. So that again gives me my little note. I'm going to add up the 300, the 3,000, and the 3,280. That's going to give me 6,580. That is my COGS for this transaction. So let me put that in my journal entries, 6,580, 6,580. All right, that takes care of the journal entries. But remember, the question asked us to find the COGS, the gross profit, and ending inventory. So let's do that now. Before I get into doing that, I'm also going to I'm going to find one other thing too. It's just going to give me some extra help for when I find out the gross profit, but I want to know my total revenue as well. And so when you're finding these total revenues or total COGS, all we're doing is looking at the line items, looking at our journal entries where it says, in this situation, sales revenue, and I'm going to add them up. So I have a sales revenue at 4-1 of 4,375. I have one at 7-11 of 10,750. If I add that up, that's going to give me a total revenue for this year for Echo Company of 15,125. I'm going to do the same thing for total COGS. I want to look at where it says COGS on the journal entries at 4-1 and 7-11, add those up, and give me my total COGS for the year. So that's going to give me a 2,500 plus 6,580. That will give me a total COGS of 9,080. All right, the next one that they want us to find is the gross profit. Now, gross profit is what we made on the sale. So it is the difference between what we earned versus what we paid for those inventories. So it's revenue minus COGS. Your equation for gross profit is sales revenue minus your COGS. So what is our total sales revenue? Well, it's 15,125. We just found it. What's our total COGS? Again, we just found it, 9,080. If we subtract the two, that's going to give us a gross profit of 6,045. And then finally, the last thing we need to find is the ending inventory. Ending inventory is really easy because we've already given ourselves that note. We still have 20 from the 6-2 purchase, and those 20 are going to be $16 a piece. So if I multiply that out, that's going to give me an ending inventory balance of $320. be careful. A lot of times when they say what's the ending inventory, they don't want the quantity, because it doesn't matter if you use FIFO, LIFO, or weighted average. The quantity is still going to be the same. It's still going to be 20. It's just a matter of 20 at what. So they're looking for that price, whether it be the price per each or the total amount. So, but that's how you do an intermittent purchase and sale using the FIFO method. So in the next video, I'm going to show you how to do the same thing using the LIFO video. Take care.